maybe you can just state it for any potential buyers out there. But first, can you just speak to the bottom line of where you would consider signing some type of an agreement at a price of, say, call it 45? What's your thoughts on that bottom line price point? And then I guess to the other point, maybe there's some that are listening, let's hope that there's not any desperate trigger happy folks out there looking to sign a contract for the sake of signing a contract at $37 or $38 when we all know that it's probably going to be a loser, but people might try to sign that early on just to say that they've got a contract. So I would encourage people to be smart about the economics. That happens a lot with a lot of these presentations, Bill, where people talk about economics that in fact are just not true when it comes to their costs. So what's your points on that?
Your last point is probably the most significant on cost. And your all-in sustaining cost of a project's fine, but you've got to carry your G&A, you've got to carry your corporate, you've got to carry your expansion projects. Unless you plan to be a static producer, a static industry with no growth, you've got to allocate funds for that as well. I think if you're going to just peg ISR production in the U.S., you'd probably look at something around $30 for all-in sustaining costs. But and of course each operator is going to vary from that a little bit, but that's probably a good round number. And but that doesn't mean you're going to want to sign a contract. And even if you've got a $8 margin, like in your instance where you mentioned 38, I think it's really not enough to ensure viability of an ongoing company. If you've got a cash flow need or some sort of debt service obligation, then maybe you look at that. I don't know, but I don't. Here again, I don't think that anybody's going to be too active until you see 45 and up. And I think you'll start seeing it creep in at 40. But here again, the fuel buyers are a herd group, herd instinct, and they tend to all act in unison and try and all get through the door at the same time when there's a rush. And so once the contracting really starts, you may have a few outliers, but I think here again, it's all predicated on a rising market becoming a seller's market as opposed to a buyer's market. So that part's very similar to 04 to 07, where the utility fuel buyers for the last decade primarily have had it available at whatever price they wanted to pay, within reason. But they certainly haven't had to chase prices, and they certainly haven't had to get all bulled up and chase anything. They've been in a very favorable market. And like anybody, you get kind of comfortable in that and maybe a little slow to respond, but when you respond, you tend to have to get with it. So that's my view on the contracting. Others may have different, but I think that's probably a pretty good assessment.
Yeah, no, I align with what you're saying. I think that's correct. The $38 example, $8 a pound on a production center that's rolling out maybe 1 million pounds a year. When you tack on your G&A, your pipeline growth, and all your other corporate costs, that doesn't even begin to strike the surface.
No, and it certainly doesn't do anything on your earnings per share.
We'll see how this plays out. And I think the utilities, absolutely, when they come back in, it will be absolutely a rampage when it does occur.